Welcome to the Deployed Podcast, where strategy, ideas, and capital come to life.
Awesome. Thank you again for joining me on another episode of Deployed. For those of you who don't know me, my name is Michael Kearse. I'm a real estate investor and fund operator. Over the years, I've worked with a wide range of investors who've built success in very different ways, business owners, professionals, and operators, many of whom eventually start asking the exact same question. Is there a smarter way to deploy capital, especially retirement capital, outside of the stock market? So on Deployed, I'm not here to pitch. I'm here to understand how successful people think about capital, risk, and long-term decisions, and to explore how tools like the self-directed IRA can fit into that thinking. Today, I'm joined by Aalap Shah. He's a physician investor helping early career doctors understand the options beyond residency. That's a pretty cool niche. How you doing, Aalap?
I'm doing great, and thank you very much for the warm introduction, Michael. Very nice to be here
Yeah,
today.
awesome. So quickly, tell me a little bit more about what you're doing for early physicians. That seems different and new.
Yeah. So, in a nutshell, to give where I'm coming from. So, I'm a pediatric anesthesiologist, and like many physicians coming out, we have our sights set on. All right, this is our job. This is a career. This is what it's going to be. As we've all seen the news, there's a lot of tumultuousness, volatility in medicine, including how our own colleagues are being taken care of and their own long-term prospects. And over the past 10 years, through both Facebook physician community groups and multiple other groups that have spun off, people have started to voice and act on their interests of being able to entertain side gigs or other ways of attaining meaningful revenue outside of the confines of medical reimbursement, which we know is quite problematic in this country. With that said, my experience, and I've been out of practice for 10 years, Michael, acknowledged and learned that there are several things that physicians would need to learn from the time they finish their training in order to position themselves not just as a great physician, a clinical mastery of their skills, but to be the innovator, investor, the thing that's burning inside them. And I've talked with countless thousands of people at this point. And a lot of this is sort of in the back burner for them. And they're just yearning and, to be able to get out into one of these other revenue streams or a passion hobby or a venture, something to really help diversify what they're doing and help at the end decrease their burnout in medicine. Because at the end of the day, we should be doing what we love doing, as taking care of patients. And I found that through a mix of getting people into different types of deals or side gigs themselves, real estate, alternatives, land funds, even, starting holding companies for their own ventures that they've been sitting on. That's really struck a tone, or really struck a note with a lot of people. And so what I've been doing over the past couple of years is creating a curriculum that focuses on accelerating this educational gap that physicians have coming out of practice to become a good, confident investor that isn't being, flogged on by, oh my God, this person wants me to invest $10,000 here and here, and they never see their money. And a lot of people have the stigma because they don't have the training to approach deals like this. So I work with physicians both through an educational curriculum called the Transparent Medical Institute, for which I'm putting out content personally and on a platform, as well as direct mentorship of physicians through a new but growing group of professionals that are interested in investing in things outside of the stock market, as you mentioned. There's real estate, land, but there's also alternatives. There's other angel investment opportunities, startup companies. And real estate is obviously something that has been talked to us from early on. And it is a great source of passive income. A little biased. My wife is actually a real estate agent, and we enjoyed her REPS status, the rep status. And she's very much into combining her love for interior design with real estate. And although honestly, real estate was something I was doubtful of when I first came out of practice, the things I've learned through these communities, as well as being by her side, have taught me a lot about the significant number of ways we can approach good secondary active and passive income, depreciation, other tax offsets that are helpful as we're getting our other ventures or other goals off. So long story short, this is kind of how we got here, both through an educational curriculum, my own experiences, and really kind of plotting out what it would take for other people to be successful and be confident as going in as investors, especially on their first deal.
Wow. So, man, my God. So first question, did you say that you're no longer practicing or that you are still practicing?
I am still
physician?
practicing, and I want to emphasize and a lot of people want to go from 100 to 0. I think at the end of the day, we all want to be helping people, and I think it's important that we get to a point where we're like, "Oh, okay, I'm going to practice 2 days or 3 days, dedicated practice." So I practice about 2, maybe 2.5 days a week, on my own accord as an independent contractor, as an anesthesiologist. I'm very happy with that. And other days, I'm meeting people like yourself, talking with other investors, IP attorneys for some of our ventures, and really kind of building what I feel is a well-rounded career around what was, the passion of medicine, but keeping it there.
Yeah. Awesome. Awesome. To clarify, are you saying that what you do is you have a cohort or a platform where you are teaching other medical professionals how to invest in alternatives?
So it's starting off, there's 5 tenets of the curriculum, but side gigs and investments is a huge part of it. A big part of it is helping people understand their own personal finances. And it's really important. I mean, we all might roll our eyes and we're like, yes, we know. But it's sad that, majority of people, let's say less than half the people in this country have a level of financial proficiency that's actually lower for doctors. They've given them financial proficiency exams. And if you can't have your own savings account, if you can't set up your own retirement account, what are we talking about setting up a self-directed IRA and setting up a transfer and having an administrator and being on top of that, right? So there's a lot of basics that unfortunately, and I have to be transparent, we're a little behind the curve. And imagine we're, finishing our training, finally making money, oftentimes 8 to 10 years after many other people who haven't gone through medicine. And so it's a lot to learn. And we don't actually learn that during medical school. I'm sure you hear that a lot. Like, we don't learn about these things in medical school, residency. Why don't we have a curriculum about this? That's a pain point that has empowered me to create this curriculum based on my own experiences too. So, I think the importance is personal finance is the first part. Again, this is a 5-year curriculum, but then we help people understand the finances of their practice and then understand how regulatory financial matters, affect their own specialties. And then fourth and fifth is then focusing on investments outside of the stock market, looking at real estate, helping people engage in side gigs, helping people start and incorporate if they want to create their own corporation in medicine or not. And really these things that are a little more advanced, but we are very well positioned to do it. We just need to pull the right levers and not be honestly just bogged down by the traditional mindset of medicine. A lot of people are like, why are you doing all this? You're a physician. Why don't you just do your job, see more patients? And it's not about that. I want to take the best care of the patients that I am right now. All right. But that's doesn't mean doing more because we know this healthcare system is a race to the bottom. More reimbursements, you got to see more patients. I want to focus on their outcomes. I don't focus on my own wealth, my own health. And honestly, health is related to your financial health. We hear about that all the time. So, Michael, that's why I'm taking this approach. I think it'd be hard sell to someone, unless someone has the experience coming out of practice day one to be like, hey, let's get into this deal together. But you're
Yeah.
inculcating a mindset and you're accelerating that mindset for what could be 5, 10 years. You're doing it a couple of years where they get comfortable. They're like, all right, I'm willing to put, X amount of money into this deal.
Yeah.
Getting to that point is very important.
That's interesting. So, why do you think that is that the medical space or the physician space or those that practice, why do you think that they lack the financial literacy
Well,
as opposed to others?
so first of it is, delayed gratification is what we're told, right? So we come out and we're like, okay, well, continue to put loans in, continue to go through school and this set track that is made for us, right? We don't have a choice. We have a tuition bill. This is our medical school. We have to pay it. We don't actually be like, all right, well, what are we actually getting for our education, right? But the thing there is, I don't have any quality about our education. The amount of medical information that's out there is basically doubling like every like few months now. It's insane, and that's the problem is that we have such limited time to learn a lot of medicine. So there can't be time, and sometimes they will lower the prioritization. For example, if a professor or graduate wants to come and talk about finances. So what does their exposure become? It becomes a last year of residency training when someone from like Northwestern Mutual or another financial firm comes to us and they're like, hey, let's work with you as an advisor. Hey, well, let's earn your business over the year. Guess what? If you invest your assets with us for a small fee of 2% of your assets, will have this and you can just focus on taking care of your patients. And that's how it's sold to us right now, still. Right? That's exactly how it's sold to us. And so people come out on a mindset that, all right, well, A, someone else can manage my money. B, oh wow, first attending paycheck. This is great. Let me just go ahead and just put it all towards my loans, or let me just go splurge. Both of which may not be the right idea. So there's no real good financial footing. And the first few steps you make right after training are extremely important. Because once you get into a pattern, it's hard to break that pattern.
Mm, God. And then how many physicians are you working with right now, or how many people in the practice space are you working with?
So to the AS Angels, which is my firm that I'm creating, this I actually just put into force about a few weeks ago. However, the community that we're building is actually a group of about 240 physicians, which themselves, it's a WhatsApp group where we're all literally texting each other every single day, every couple hours there's a text. And we have it broken down into real estate, venture capital, passion projects, taxes. It's a big group of interactive individuals, but our focus right now has been a lot more on, for example, tax savings or venture capital, like companies that are well established. There are some, deals regarding real estate. We have actually a couple, for example, assisted living facility in Silicon Valley, a hotel chain that's really in Google's backyard, for example. But it's limited compared to the number of deals or options when we're talking about venture companies or else or the other commodities and even crypto that people are talking about. And I want to increase the chatter. I want to increase discussion and discourse over things like real estate. Obviously, my bias having been in it, and I forgot to mention, like my wife really is the management. We have 2 properties in LA, and we get to actually see the amount of work that it takes when we're actively managing, when we're serving as landlord and property. And how do we take that and I encourage people to, hey, if you're in a good place where, you have time, you have someone who's got time to dedicate and have the rep status, they can manage it, or fine, don't. Like, it's very difficult, takes a lot of time. Well, then there's different funds. Like, for example, the ones that you may be representing, or land deals, or other things that you can do where you can really diversify that income.
Yeah, yeah. Well, go ahead. I'm sorry.
As like this discussion then led me to go back to LinkedIn, because remember, I'm focusing on a physician focus forum. And I went to LinkedIn. Honestly, Michael, like literally about a year ago, I made one small change to my LinkedIn profile. I took, instead of saying, physician anesthesiologist or clinical assistant professor, at the time I was in academia, I literally just changed it to investor and then a physician investor in the first part of my tag. And that honestly opened up an entire world. Literally, most meetings, including yourself, I feel have come from that. Like the connections that I'm meeting and forging have come from the fact that, hey, there's a lot of people that are really interested in not in investing, but getting physicians to the table, understanding that, we come out, we've got capital, we want to be strategic about it. And people like me that are like, yes, yes, I want to do it and I want to get other people to the table too. So that's what LinkedIn has been for me, and connecting with people like yourself. I connected with the orthopedic surgeon, Dr. Kirk Campbell, Illinois, who just closed on his first deal. You should look him up on LinkedIn. It's great. I mean, just very inspirational individuals, and I want to help push them forward and create this ecosystem that's very similar to what you're doing.
Man, I think that we have finally met each other. I think it will be a great blend. We'll talk about it more offline, but yeah, I think you and I will be a match made in heaven. So I'm pretty excited.
Well, great.
Wow. So thanks for sharing that, man. I'm pretty excited. So I want to switch gears a little bit, and I want to tell me about what your path to success has looked like. How did that happen?
Path to success is failure, failure. It is. And even with this curriculum, I'm telling people, I'm being like, look, you're going to have to learn a lot of stuff by yourself. And I want people to get comfortable getting the street smarts. You've done the book smarts, you've done the clinical smarts. Now it's literally, like learning on a job. And that's DIY is portion of it. So really kind of getting out, like I said, I came out having a clinical mindset. I'm like, I want to come to California. That was my pipe dream, right? I want to live in California, grew up in Michigan, all these cool places. Fine, I made it. And then it's not enough, like I said, to just have your mind set on like, all right, I'm just going to be a clinical master and let all the money follow and nothing else matters. It's not unfortunately true anymore. So really understanding that it is a tough pill to swallow. That first year, that was very important, because instead of just going straight into a W-2 job, which I could have, I learned about what it's like to incorporate and basically create your own business. And I think that's really important, because that's a thing that really stops people, or even when they become an LP for somebody else, or you have to understand the ropes. And people think that incorporating is like $1 million thing, but is actually very simple and straightforward. And learning that, and then learning how I can use my license and my board certification to work with other things in the clinical medical space. Then using those experiences to then start knocking on the doors of the C-suite. So like I'd work in different hospitals, surgery centers. I knock on their doors and be like, hey, I want to propose this project for you to improve the care of patients. And then I get the chance to actually staff a group during the pandemic because the anesthesia groups, people were retiring, people did not want to work in these hospitals, we're intubating patients left and right, we're exposed to COVID left and right. And so we actually get to staff a couple of underserved not rural, but underserved community hospitals, Medicare, Medi-Cal heavy hospitals, East LA, which then allowed me to learn basically an entire field of knowledge regarding the administrative side of medicine, reimbursements, requests for proposals, and actually learn about how to manage the profit loss spreadsheets. And this, honestly, that was really the thing that catapulted me into looking at these other businesses and profit margins and COGS and all these different things. I started looking at financial spreadsheets of like everything, every company I looked at. And then around that time, I met my wife before then, a few years before, and I was very much against real estate. But again, getting into that, going with her, she represented buyers and sellers, literally learning from her, carrying the signs with her. You gotta do it. You gotta put yourself in it. And I think it's very important to learn it every step of the way. I don't want people to be like, all right, pay $3,000 or $5,000 to a black box and have someone do it for you. Be like, all right, pay a little bit, but learn a couple of the steps. Figure out this is what you want, and use that knowledge to get to the next step. And we know how to
I
get our
love it.
medical license. We did that for a long time. Now, how do we create a business out of it? How do we contract? How do we partner? How do we market ourselves? Well, 10 years out, can't create a simple website for themselves for marketing because they're scared, or they're scared they're coming across as too showy. But a website is like, 20, 30, it's like 2 decades old now.
Yeah. Yeah.
And so accelerating that, but putting yourself there and doing it and failing and then learning from it. Make notes to the next thing.
So I love that. So as you became more successful, how did the way that you thought about capital evolve?
Well, this is one thing I could have done better, right? So for me coming out, I was like, oh, capital must pay off debt. And I'm not saying that's a bad thing. I mean, especially if you have credit card or high interest debt, I would personally not recommend that. I'd be like, hey, you should focus on those things. But I think, a lot of people are very excited to get that paycheck. The good news is like sometimes people are like, I just want to pay off my medical school debt. And I remember coming out and I was very lucky, right? I had my interest rates were consolidated 1.75%. That was my interest rate. I know it was their First Republic. No wonder they're not here anymore. But back in the day, this was pre-pandemic. Even our federal loans were like 3 something percent. It was so low. There was like no nines to pay it off, but I wanted to pay them off because I was like every year I like seeing that cha-ching, pay it off. But it was very defeating because I'm like money in, money out. And I'm like, all right, well, I'm looking at my friends doing this, or you going into simple vacation. I'm like sacrificing that. I'm like, maybe throwing all my money into debt isn't the right thing. So that's how I used to think about it. Like money should go towards paying debt. Whereas the reality is like some of it should, and you should continue to make certain student loan payments. Whether or not you have loan forgiveness is a whole separate question, but I always recommend people be responsible and do it in a way so you at least help yourself if you want to get buy your own first house and you don't have a huge debt, all right? So you have to consider those things, but it became clear to me that I should have invested some of that money early on, even if it was a stock market. And over time, like I said, I'm 10 years out of practice. I wish I had this knowledge, my confidence now 5 years ago, like meeting people like you 5 years ago. And I feel like I could have done that by deploying my capital a little bit better, not just putting it out towards debt or like loans early on, and experiencing some of these things, like real estate, even for example, in 2016 is when I came out of practice. I really started getting, I mean, we bought our house in 2019. I was with my wife 2018, 2019, really getting into this more investing space in 2021, 2022. I wish I'd done it earlier.
Interesting. So what do you think separates people who accumulate capital versus those who actually deploy it well?
It's a mindset. So accumulating capital, anyone can do, right? You basically go, you're really good at savings, we can do that. And I think we all tend to do that to prove it to ourselves that we can accumulate capital through savings. All right. Really flipping the mindset is basically being able to have, first of all, you have to have money that you have to be able to park. I think people think that every single dollar has to be accounted for, that they're not going to be able to pay for their food. You have to be 100% confident about your own personal expenses, which is why, Michael, I mentioned that the first tier of a curriculum, TMI curriculum, is personal finances. It's not just like being management, being good, it's being comfortable, having a financial statement written out for yourself and not spending another dollar over that. That's where you go from simply accumulating, and you're still accumulating, that's the thing, to actually being able to deploy. Then the next step is literally going out and meeting people like you, meeting other people who've done deals. You've probably heard of companies. My colleague, for example, Peter Kim hosts Passive Income MD. It's a big
Mm.
physician community, hundreds, thousands of physicians in it. They have things every single year. And he has a real estate division of it, curbside real estate, and he's helped countless physicians find loans for their own properties, but also help people get together for real estate deals, and not just deals, but educate them in for things on Zoom or info sessions to really help educate people. So I really tell people to start going to those, right? Because those are you're learning. And nowadays with AI, you should be able to have a note writer and synthesize and reflect and read in those notes, even if don't feel like you can't join those conversations. But those conversations are important. You should be joining those maybe a year or two out of practice after you have a good grasp of your personal finances. So join those things on those webinars, learn, stay after, ask questions to them, get their information, meet with them, get more information from them, and then learn about an entry deal. If people think that you need 25, 50, $100,000, but there are smaller deals out there for people to start. There's even angel investing. And that's what AS Angels is actually about. Our first couple of deals that we're looking at, entry point is only $2,500, whereas the minimum for many companies is like at least not 10, but actually 25 or 50K, which is a lot bigger piece for people to bite off. Number three, making it a piece that people can bite off comfortably, even if they
Hmm.
have good confidence over their finances, and easing them in. So after the education and everything with the webinars. So at that point, you're getting closer to deploying capital and doing it so confidently. This is all things that I did just late in the game. And then you do it. You have to do your due diligence, and there's so many Excel spreadsheets and things and calculators out there to evaluate a deal. But I tell people to just start evaluating deals and start comparing it. And there's communities out there where you can talk to other people and be like, hey, this is what we found. And then you need to stress test those deals. What is the worst thing for example, in real estate? What happens with interest rates? They're all over the place. What happens if your capex, goes up, or someone, the GP wants to take things in a different direction, or there's a natural disaster? How, Stratford Capital is a firm that you're investing with, or can they, what is your ROI? What is the potential loss and the risk you're taking if the worst case scenario actually happens? And so learn to stress testing, simulate things, and then you're ready to invest. Because at that point, you're probably doing a lot more than 90% of investors are. And a lot of because I think that a lot of people these days are like, I'm feeling good today. I've got some extra money. I like you. You attractive deal. Nice slide deck. Let me go ahead and give you some money. I think that's unfortunate what it still is. And we want people to be educated. So when people come into our platform, they see everything the way we see it. When we're evaluating deals, I want them to see it the same way. And there's no black box. I want them to see the deal. I want them to see the people behind the deal. I will give them the stress test numbers and tell, hey, take these numbers and stress them further yourself. Right. So that's how I approach it, and build trust,
Like
but
that.
also build confidence.
Yeah. So, how do you personally think about risk today versus earlier in your career?
It's interesting because it's very, very interesting you ask this question. I look at it like this, right? When I don't know how you're looking at the camera, but when I was taking out of training, I was like, initially I was risk averse because, like, dude, I want to get a job, I just want to stay here. I don't want to be kicked out of California. It's hard enough for me to get here, right? But then, it jumped up to like risk, right? Because I'm young still at that point. I like to think I'm still young, but I didn't have kids. I wasn't married yet. Like, you have an extra degree of freedom. I want to go somewhere, buy something somewhere else. So I was very risk jumpy. But then I felt in my mindset that, hey, buy a house, got kids, trying to establish a job. And so my risk, what I thought was my only risk indicator was going down. But what was really happening was really just, understanding that it's a mind game, right? It's like, yeah, the risk that I take to sacrifice everything for a crazy deal, sure, I has gone down. But my risk tolerance going up is because I feel more confident having seen other people having done these things that I just talked to you about. And so I felt that I want to take less crazy risks or less jumping things. Like I could, when I first met my wife, I was like, hey, let's go to Eureka, California, like 500 miles for like a month, and like let's go work there, and maybe we'll like it, or like let's go, And I would have been putting money into random deals or thing back then had I had it, which is scary. But now we're stuck in one place, right? I'm a family. I've got a barking dog. I've got two kids. Um, and but now I'm like my risk tolerance for things that have some strategy behind it is higher because I feel I've got more knowledge and confidence. So
Yes.
it's a different
Yes.
type of risk. Yeah.
Yeah. That makes sense, right? As you start to acquire more, it becomes more about preservation as well. What role does liquidity play for you at all?
Liquidity, like personal liquidity, or
Yeah, like personal liquidity, like with your finances. Does that provide you, or is that important uh, for like predictability for you at this point?
yeah, I mean, so I look at it as buckets of liquidity. I mean, there's a bucket that I thought was one big bucket back in the day, but now is a bucket for taking care of, day to day or, expenses for the family. You've got the expenses for my corporation, for keeping the lights on, so to speak. So those are all liquid things, but I keep them in different buckets because at any time one bucket might require more and I have to have other buckets to come from. So I look as liquidity as still almost distributed liquidity. But then there's
Mm,
also the concept, and what I'm really interested in is the concept is your retirement liquidity, because that's the kind of people think of retirement money as just, all right, it's locked up. Bye. I'll see you when I'm like 59 and a half or 60 or never. I'm like, yeah, you shouldn't think like that. As a matter of fact, if you're really successful, you can have that and still may never even need to touch that retirement money because you got things coming in, rolling in, passive and sale. Maybe you made partner, you sold your surgery center. I want people to have money and not need it, right? Not to touch it. The mentality is like for people who are like, all right, let me get to that point. I'm putting money there, but it's illiquid because I'm not going to be able to touch it, no matter how bad or good things happen to me 5, 10, 20 years down the road. So then, I started thinking like, well, there needs to be more done with the retirement money. It can't just be simply, I'm not gonna say boring, but the three fund approach, or all right, let's put it into some exciting stocks in like a downturn. But it needs to be able to be deployed. And I'm like, people are spending $10,000, $25,000 checks from their own personals and then stretching their finances for their own food because they were saving up to make an investment in this cool company. Well, why can't you do it with your retirement money where it's not touching your personal day-to-day distributed buckets of liquidity, but it's still liquid and that you're able to put it, exercise it, not exercise, but, contribute it, invest it, and follow the company, follow their metrics. And even though you can't touch the money, you feel like it's live, it's on fire, it's doing something, it's part of exciting. And even though it's still, you can't really touch the money, it feels more liquid because you're doing something that you want to be doing with it now, right?
I
So
love it.
that's how
I
I
love it.
approach liquidity.
I love it. I love it. I do something similar. I like how you broke it down with the liquidity distribution, right? You have your, the home. I look at it as we have our home account. I have the business account. I have the fund account, right, for real estate investing. And to your point, right, you just kind of manage them as needed. That was interesting how you broke that down. I can relate to that. At this stage, what kind of investments don't interest you anymore, if any?
Everything interests me. It's a factor of time. I think, things are volatility decay and leverage things tend to not so much because, you lose out to a lot of the, you know, over leveraging as a strategy is not good, especially I've seen people do it in stocks. I've personally done that. So I've learned from that. Like tell people, it's very dangerous.
Uh,
It's a matter of time, yes. Like, for example, real estate, it was very attractive. It is really, really attractive. And for example, there was a time where, when you're looking for personal properties here, we purchased a property when it was, you know, the height of the excitement, but the rates were going super high. And that was an investment hopefully that we wish that we had made, a little bit later or waited a little bit. Yeah. Sorry, I think you're muted. That's okay. Bad investments are really the ones, really how it's sold to you. And I think it's really comes down to the people behind it. If someone's coming in, like talking about something that they don't have any experience in, but they're just super excited because hey, he's got like a good keyword. Like for example, like blockchain, Bitcoin back in the day. Unfortunately, now you've got a lot of AI companies. I mean, like 90% of AI companies, their algorithms aren't actually successful, and many of them actually fail. Unfortunately, and so, it's about the timing. Like AI, you could have hit 2 years ago for money into an AI company and probably been pretty successful. And now it's a little more, people are scrutinizing it quite a bit. So it's about the timing. of it. But deals that are generally totally bad, no matter what, is how it's sold to you and who you are. Like if I would, and you can't invest in something you don't feel comfortable with, or you can't learn with, and you at least see like the financial projections of P&L, and like, okay, I can grasp this a little bit. But there's certain things where people might be investing, like let's say like South Korean fried chicken, which I'm not joking, was for a very short time great investment. When Jensen Huang went over there and was photographed having fried chicken, and all the stocks soared 500 to 1,000%, and people actually made a lot of money. And you just had to know that, and you had to be on top of that. I mean, it wasn't a bad investment at that point in time, but it was right after that when everything tanked, right? So South Korean, economy is struggling too. So again, timing, yeah.
Interesting, interesting. And so, how do you decide if something is worth your attention versus it just being noise?
For me now, like I said, the risk tolerance kind of goes with my how much I can grasp it. Like if someone can give me a 60-second pitch, and it's not my thing, and I don't understand it before the pitch, but hey, I'm starting to understand, and this is cool. It hits on a pain point, and I do actually know this. I'll give them a second meeting, for example. But like I said, if someone comes to me like, hey, like, I'm not going to name companies, it's not fair, but there's ones that have been out that have literally continued to ask doctors the same day, $10,000, and they have not generated any revenue. The person is basically, oh, I'm going to go back to business school and learn stuff and give me a few years of investment, and I'll come back and I'll be a good CEO. I'm literally talk with a company like that. I'm like, what's going on here? There's not, you don't really have a good, strong vision. And obviously, you want to have good people on the board, people you partner with, and who've got, at least some experience.
How did you first learn about the self-directed IRA? How did that happen?
Let me just make sure here. Let me just make sure I'm not missing something here. So the self-directed IRA, I was learning basically because I wanted to make same thing. I wanted to have, I was feeling illiquid with my personal buckets, and I wanted to still be able to invest. And this is, a few years ago. You've got companies like SpaceX and Anduril, all these companies kind of making their debut and kind of coming through and making sure their offerings through small venture capital companies, and then talking with other people that were working with these companies, were LPs. I had some direct connects with some C-suites of a couple companies too. And they're like, hey, Alap, why don't you think about, you could use your IRA, you could use your retirement fund. And at a certain point, I was still trying to like, all right, let me at least have the basics done. Let me have the mutual funds and everything. But then I got to a point where I'm like, okay, well, let me, it'd be great to sort of deploy some capital, but I can't do it for my Charles Schwab retirement or a pension account house in there. How do people make all these alternative investments? And yeah, people were investing in debt and credit and oil and gas. And so then I started, and they're like looking at other IRAs, and it came across the solo 401k. Long story short, I do have a solo 401k and a cash balance pension plan that I've created over the past couple of years. But that solo 401k, on top of previous company retirement accounts, when I left those companies, they were in a rollover IRA, and I'm like, hey, I can have them in these mutual funds, but I can take a portion and I could transfer it to a company like Neighbors and have them as my administrator for like a self-directed solo 401k, or a self-directed IRA, IRAR resources. And so then learning about how the FBO, like all the paperwork, making yourself a beneficiary for the company, having the money sent out, potentially having like a gold medallion signature needed, like all these things. I'm like, oh my God, I didn't know you could do this, but you can move money from one thing to a self-directed IRA. And now I feel like I actually have control over this money. I can deploy in all these companies. So I did it the first time around with the self-directed 401k through Neighbors. And then for another company, I did it because I had a rollover of IRA from my previous employer. I then used that to go to IRAR as a self-directed IRA. And then I used that to invest in a few companies now. So in between that, I've got a dozen or so just investments just from my retirement accounts that I'm able to play with, follow with, and yeah, it's really exciting.
That's awesome. Awesome. Well, what surprised you most once you understood how it worked?
So what surprised me was the fact that I could actually do it. That's really what it is. Actually, that's what it is. It's like kind of like, I don't know. It's how I feel like, for example, when you play a new instrument, you do something new, and you're like kind of scared, you got all this hesitation, and you do it, and you're like, holy crap, this is not that hard at all. And you kind of build this. Unfortunately, it's a little bit of beginner's confidence, right? A beginner's luck. Everyone feels a little cocky, and sure, you don't want to be too cocky, but that beginning confidence boost is still very important. And so it kind of was like, okay, well, I did this all the way through. The money is made it. Like it wasn't as painful as I thought. And for me, it helps to kind of have like an iterative, like, self-improving sort of mentality. Like, I went through this process. How can I make this a little bit smoother? Whether the printing, going to the post office, or getting the signature, how can I streamline this? Maybe I can make a better relationship at a bank or the IRA, so I can direct call them and take all this, taken care of really quickly. Because people get very, they get pushed away when there's lots of documents and signatures and everything. They feel as they're giving away a part of their soul. But you can make that a little more streamlined. And I did over the first few investments and felt very comfortable. And I think it also helps to have direct lines in, like literally being able to text anyone with any of these deals or investments, and be like, hey, what's going on? Or I have a question, and they'll literally get back to me in an hour. I mean, you can't say that about the stock market. Some people realize that there's a value. Yeah, there might be greater risk with angel or certain types of investing. I mean, not so much in real estate, it's more diversified. There's definitely more risk in angel investing, but my God, you have a little more, proximity to key individuals, and you have more room to potentially be more involved. For example, with angel investing, you want to, if type your company, you can be an advisor. Um, and so helping people understand that they have multiple roles, not as an investor, and doing it this way helps them open up their brain and their heart to other types of deals, including real estate and stuff that is already pretty established, but can also be, real estate, it can take a lot, especially if you're managing your own properties. We all know this. But once you get through that, it gets a little bit easier the next time. So it's,
Mhm.
yeah, yeah, that's
Well,
where we
so
are.
I love that you share that, especially about real estate, right? But why do you think retirement capital often aligns better with the passive investments more than the active ones?
Well, well, it depends because of the people themselves, right? Because they're working. They don't, we're patients all the time, and we get frustrated. We're like, oh my God, I wish we had got on my phone and bought this stock or bought this. And like, we realize that we can't do active investing because we're actively so busy with our jobs. And we need something that comes in reliably, passively, that does not detract from our act. And so that is the biggest thing is people think about passive investing because they are so busy with whatever they're doing, building a company, building their practice. It becomes like in want something that's secondary that can bring us extra money in. And if things work well down the road, we can look at it a little more and become more actively involved in it, kind of like we were with the real estate and my wife doing and becoming a landlord of a property. But it's really about time savings. That's how I'm just telling you how people come into it, like literally the mentality of the first 2 years out of training. It may not be the right mentality. Why? Because we know not everything is truly passive, right? I mean, angel investing, you write a check, sure, it can be truly passive, but a lot of people want to have some sort of active involvement with something over time. And, but they want something that does generate, income without them having to look, over and over again. And so that's where they're like look at mutual funds, right? That's safe, a little bit safety right there. But then after that, all right, what else is passive? They start thinking about real estate a little bit because real estate is associated with passive income. If you can have a good tenant in there, good tenants in there, and yeah, it can be considered passive. I guess what I'm trying to say is that, that's how we think about passive income. And we learn along the ways that it's not as passive as we want. And there's actually a spectrum of active and passive. And there's multiple investments and different ways you can be involved. And you can be completely passive. Real estate is not necessarily passive, especially if you're managing a property, it's not completely passive if you've got turn tenant learn to love. But then a lot of those people that learn about, all right, let's put it into a real estate deal or syndication or REIT. And I feel much more comfortable and then they don't have to worry about that, and they just get like the checks every month. You got to learn about it each way. I think. And I think it's important for people to learn about what it's like to be a little bit of a landlord for themselves before you put money into a deal.
Absolutely. What about lending versus like ownership or operations? Do you prefer one over the other?
Are you talking about like our firm like being like a lender versus like owner operator of a unit of a project?
Absolutely. Yep.
So we are really kind of more focused on kind of getting people to invest more in the lending and investing side. We feel more comfortable. Down the road, I'm not never rule it out. Like if we came across, multiple people in our group, we're like, okay, let's actually go in as partners for this property and then actually do something like this ourselves. I don't think we're there yet. I think we feel much more comfortable evaluating deals. You have to also understand a lot of this interest came during the pandemic when real estate became really popular. But then as we all know very truthfully, there was, 21, 22, where a lot of real estate hype kind of like died down. A lot of deals actually went bad. There were a lot of capital calls. A lot of people were really upset. Not everything, but they were there. And so people then realized, okay, we're like, okay, well, it's a lot. Imagine if we were owning the property and having to deal with all that stress on top of our day jobs. We'd rather just be investors and learning, and let's use the next year to like learn and evaluate deals. And that was a year or two ago. Now we're looking to invest that money.
Got it. Got it. That's pretty cool. Thanks for sharing it. So what advice would you give someone sitting on a large retirement account who feels stuck in the traditional options?
So the first thing, like I said, I would stick to it, is start going to webinars. Or, I can go to one every single day for a different investment or a company or something, and just go there. I can stay after, I can talk with the people, I can go ask questions. I mean, that's like free knowledge, right? Like people go to business school, spend 70 to 100K to learn a fraction of that, and then they go like, but then they realize a lot of it is just networking, right? And that's true. I mean, a lot of the value is there, but it's available at your fingertips now, and it doesn't cost you a dime except for maybe get some emails. Like, it's start going to those, start learning, ask questions. What I honestly do, and I don't want to bring AI completely into it, but it has helped. Let's face it, is I'll have like a meeting summary or note taker, and then go and like summarize it so you have notes and be like, hey, what should I do with this information? Should I contact this person to learn more? What questions should I ask at the next webinar? Should I start constructing a spreadsheet for myself? You can even have Claude basically start creating a thing like, for evaluating a deal. You can give it a deal and it'll stress test it for you. You don't have to do it yourself anymore. Just start doing it, putting it into the system, start evaluating it, using AI to help. Every time you have a question that you think would be like, oh, this is something this question is why I'm so frustrated. I don't want to deal with it. And there's other people that can answer this question better, and it's just not my thing. Every time you feel like that, you should be asking the question and closing the gap of knowledge and confidence, and coming out and being like, okay, well, now I know this. Let me go to the next step. And in terms of the questions, in terms of the billing, evaluating, going to the specific deal, and eventually pulling the trigger.
Yeah, yeah. Aalap, this was amazing. Thank you so much for sharing this. I'm so excited you and I met. You and I are going to definitely talk offline. I think
Correct.
that
Look
you and I
forward to it.
can do a lot together. For those of you who are watching live or those of you who are watching the recording, if this conversation resonated with you, share it with someone who's built success and is now thinking more intentionally about how to deploy their capital. And if you're curious about how the self-directed IRA can be used for passive real estate-backed lending, you'll find some resources in the description. Thanks again for listening to Deployed. Thanks again for joining us.
Thank you, Michael. Thanks for having me. We'll talk soon.
You've been watching the Deployed podcast, where we deploy insight, capital, and growth.